Welcome to the Retiring Real Estate Investor Podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Incitti Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Incitti Investment Advisors, LLC and its representatives do not provide tax or legal advice, and nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Hello, everyone, and welcome to another episode of the Retiring Real Estate Investor Podcast. I'm your host, Brandon Bruckman. I'm excited to be joined by Matthew Incitti from Hamilton Point. He's a vice president of sales and marketing there. Matthew, how are you?
I'm doing well, Brandon. How about yourself?
I can't literally be better. Perfect day as usual. Maybe Matthew, start us off this way. Give us a little introduction for the listeners about who you are, and then a little bit about Hamilton Point, and we'll kind of dive in from there.
Yeah, absolutely. Again, appreciate the opportunity to be here. Heard a couple of other previous iterations of this, so I'm looking forward to it. So as you mentioned, Matt Incitti with Hamilton Point. I live outside of Philadelphia. I've been in kind of the real estate world, different, variations of it for almost 20 years now. And started kind of my career as, more of with asset managers. Actually kind of an interesting story in the sense I actually kind of knew I wanted to do something in finance business growing up. And in college, I actually worked directly with one of my professors who worked in the real estate kind of endowments or the real estate piece of the University of Connecticut endowment. And he taught me a lot about the business and kind of broke it down for me in some pretty simple ways. And so that kind of led me to the career in real estate, different asset managers. Was in Connecticut for a while, in New York City as well. So ultimately, like I said, it led me here. Hamilton Point is a private equity real estate manager, primarily in multifamily, conventional multifamily. Our focus has, for the better part of our 15 years, have been in the Sun Belt kind of area. And we produce a series of funds and ultimately pool investor capital and look out and for attractive, entry points in different types of real estate, mostly, like I said, multifamily. We currently have kind of our own thesis, which I assume we'll get to, but ultimately we've seen different opportunities in different times, different periods of the cycle, like anything else that things cycle through.
Yeah, and I think that was the most interesting part about, my introduction to Hamilton Point in the shop was, I'm like, oh, okay. The thesis here is always evolving, right? And you're always sort of looking for opportunities in unique ways, right? There doesn't seem to be a cookie cutter approach like we do this over and over again. It's like, okay, that's good if that works. In certain markets it doesn't, but it seems like you guys are very agnostic to that, saying, all right, let's look at the marketplace. Where does the opportunity lie? Let's talk about that right now. What's the thesis currently that you guys are focused on?
Yeah, absolutely, Brandon. So, it's really just to start kind of when we first kind of entered the market, if you will, and the company formed in 2009. That was coming out of the global financial crisis. So as I mentioned, each of our funds at different points of the cycle produced a different kind of story to it in terms of, how we're raising money and what opportunities we see. So it started in, looking at distressed assets coming out of the global financial crisis, buying out of bankruptcy, receivership, et cetera. Then kind of as we evolved and we actually started to raise a little bit more money too, we transitioned to more of a value add approach. So we're talking fairly heavy value add. So like buying 15 to 20-year-old, conventional multifamily B units, if you will, and fixing them up, right? In terms of roofs and interiors and et cetera. And then ultimately deploying that and raising rents and selling it out to various, in disposition. So now to answer your question, as we're here in this point in the cycle, we're seeing opportunities to purchase directly from builders. So kind of the story being is you've had a record amount of supply that's actually hitting the market now in a lot of these high growth markets. So think Texas, Florida, the Carolinas, these migration patterns that everyone emphasized. People are moving to Florida during COVID. It's funny because it's actually a 30-year trend. People have been moving there for 30 years. It's just more pronounced, and it was more of an acceleration during COVID. But yeah, we see opportunities right now. So like I said, there's been excessive supply that's entering these markets. These builders started permitting and entitling the land, 3 years ago, call it. They're selling into a different capital markets naturally, right? Different, rates have doubled. And there's also a lot new supply. So they're taking a little bit longer to lease up. So, bringing in renters is going a little slower. Meanwhile, they have, construction loans that are variable rate coming due. So they've made their development fee throughout. They've also most of these builders had made a killing the last couple of years with new supply. So it's taken a little longer. They're builders, they're not managers. And so we see opportunities to purchase directly from them. We assist in, property management. We're vertically integrated. So Hamilton Point Property Management kind of oversees and takes over those responsibilities, fix things, some operational things, lease it up, and then ultimately looking to hold. So we'll do typically some bridge financing if we're not at that 90%, full stabilized property. So, and then of course put permanent financing when the time is right, when it's applicable. So that's what we're seeing. I mean, really our last couple of, vintages, if you will, have been kind of that same story in terms of looking at oversupplied markets directly from builders and ultimately kind of a basis play. The other thing I'll mention too is I mentioned oversupply. Well, now we also have visibility into the new supply wave, right? These things take a couple of years. You see permits, you can pull them anytime you want in various areas, and it's virtually, non-existent. So it's slowed down dramatically. It's a combination of record supply. It's also a combination of it's tough for these deals to pencil.
Yeah.
So, I mean, of course, we'll see what else happens to it.
It's sort of fascinating to me, and then maybe it's just the timing of it, but the drastic oversupply in some of these growth markets makes me really scratch my head. Like, why does this happen from a builder perspective? I'm trying to put myself in their shoes, right? And say, okay, why didn't I see the fact that this is going to be a drastically oversupply market when I started this 2-3 years ago? Do you have thoughts on that? It just makes me scratch my head.
I lost you for a second, Brandon. I apologize.
Yeah, I see that. That's on my end. It says the internet's unstable. Let's give it another try. I'll just cut that out.
Yeah, no
Did you catch all the question there or no?
I did. I caught it kind of curious why that is the builders. You said the oversupply.
Yeah, you're on to it. The rest of it is just fluff.
Okay.
Thoughts on
how
does it happen?
Yeah. It's a fantastic question. I often wonder that myself, because they have the same data that we do. They probably have just as good, if not better data, especially from their perspective. So, and of course, they've been doing it in these markets for some time. A lot of it has been, just looking at kind of the hard data behind this computer screen. Sometimes, of course, they obviously have experience in that market, so they feel that it can be absorbed. And it's interesting, a lot of this is being absorbed. So I think a lot of it has to do with perhaps it doesn't, it's not absorbed as quickly, and they maybe have that concern going into it if things change, especially in the new supply. But they probably didn't have the visibility in terms of the capital markets and the interest rates. But I think they're okay with it because they've made, like anything else, right? We talk about cycles. I mean, they have their own cycles and some are better than others and some deals are better than others and they're going to experience that too. But as long as they're building, they're doing their business, then ultimately they think they feel that it's appropriate. And ultimately, it's a timing thing too. So if they sit out a year or they go to a different market when they have less experience, then it may not work as well in their favor. They'd rather go into a market that has a little more hair on it, but it ultimately is something they're more comfortable with, a market they have experience in, then they're willing to do it. That's just my kind of humble opinion and what I've seen.
It seems like they have a hammer, literally, right? And there's a nail, and they hit it, and that's building. Like we need to build, right?
That's
And
right.
I don't want to hold this property after I built it. So that's get rid of it. And then you guys are happy to stand there and go, look, no one's you're in a position where bank's not going to refi, capital markets issues, right? Don't see that coming, right? I get why builders went who did, right? I mean, some people were smart enough to see that coming, but the drastic change in how fast it happened, right? People caught off sides, get that, right? So they can get out of that property, they're happy as can be, right? Even if it's at a level they probably didn't anticipate, right?
Absolutely.
Yeah.
Absolutely. And they made their development fee. And then I think I've talked to someone, a friend of mine who's in the business, he does more of the industrial stuff, but ultimately, they look at it in terms of like 5 and 10 year periods, right? And ultimately, like we're building, to your point, we have the hammer, we're going to build, that's our business. And over the 5 year period, it looks pretty darn good, even if some of the deals were better than others. So that's kind of, one way to look at it, I guess.
Gotcha. How bad do you think it is from, I mean, are we talking about distress at this point from their perspective? Or is it, can they see that coming around the corner? Like, I got to refi this. And all of a sudden, the property we thought was going to be at a 4 cap really trades at a 6 cap. And we're kind of in trouble there in the refi. Is it more of the looking around the corner? Or are some of these folks actually in a little bit of trouble?
Yeah, yeah, I think it's the latter. It's a little bit of both, right? But at the same time, generally speaking, but we're kind of say we're focused on opportunistic, distressed, sellers, right? Not assets, um,
Mm.
but ultimately distressed sellers. So these folks are just like in a little bit of a, kind of a quandary, in the sense that they have to decide what to do and perhaps holding on to it. I mean, we've had a couple of deals in the past where, we've had a seller, perhaps a builder we've worked with, in this case it was, and they said, it's just not, we're not there yet. We're going to wait. We're going to lease it up. We're going to wait to see how things changed. Fairly fickle business, like a lot of them. And they came back to us in about 6 months, and we ended up buying from them. So because things were moving a little slower and they were kind of losing patience. So
Mhm.
it's an interesting development. You just have to, like anything in business, kind of develop your pipeline and stay on top of some of these folks. But
Yeah.
because things do change quickly. You reference with the rates, those velocity of rate increases in such a short period of time. So
Yeah.
it's something we have to kind of keep on top of.
Yeah, it's mind numbing how fast rates moved for everybody. Sort of shook the jigsaw puzzle pretty hard and quickly. Um, when you look at markets, you mentioned growth markets in the South. Is that the driving point, or what else is driving sort of the markets that you pick, select, and want to operate in?
Yeah, yeah, another good question. So it's really population and job growth is really our two primary drivers. Obviously, areas that we've worked in the past, we have boots on the ground, et cetera. But so certainly that's a driving factor is if our experience is there, and we have, even from a builder, we know what type of product they build, right? We know the quality of construction and all that. So we're buying, in this point in the cycle, typically focused on new builds. So there's not a lot of capex, but we do know what type of product these guys are building. So um, that's really the drivers. I mean, you look at, obviously, debt to income ratio of different, the local geography, the cost to own a home. I mean, a lot of this too, being multifamily, it's always been a preferred space of mine and certainly of Hamilton Point, but it's necessity based, right? People have to live somewhere. And then on top of that, it's the lower cost alternative to the only other alternative of owning your home.
Hmm.
Unless, of course, you move into your parents' basement. But that, you know, no judgment.
You never know.
That being right. But that being said, it's an interesting. So it's typically the institutional favorite in that sense. I mean, there's typically low, capital expenditures when you have, a fairly good, newer build or well-built product, and somebody leaves. You ultimately, on the turn, you may rip out the carpet, paint the walls, and you bring somebody else in. It's funny. You mentioned this early, and I do want to point this out. I mentioned that college professor
Yeah.
back in the day and just kind of why real estate and what kind of simplified it the most for me. I always think of it this way. It's in simplest form. You mentioned, cap rates before. Always think like buy at a 5 cap, you grow it to a 6, you're growing your net operating income, and then you're selling it at a 4 cap at a
Yeah.
higher price.
Yeah.
It's as simple as that. So just how do you get to those, inflection points or points of emphasis during it, when you're penciling out a deal, and obviously you're operating the deal. So it's no different with our business.
How hard is that to do today? Is to kind of make that move, right? Because we see declining or flat rents, maybe some movement upwards this year. We see the bottom line being impacted by increased cost, insurance, etc. How hard is it to really grow that 5 to 6 at this point, and then to turn around and really sell at a 4, given the capital market constraints? It feels like we're running uphill, a couple of blocks of ice on our back in a snowstorm at this point. Am I thinking about this the right way?
Yeah, there's a lot of things to be concerned about, and like we talk about the cycle, every cycle is a little different, but certainly there's some interesting, points of emphasis in this point. Yeah, I mean, operational efficiencies, there are things you can do to lower expenses and provide a more efficient experience for the tenants, for obviously running the business, and the apartment complex. So we're just focused on, areas that, like I said, we can probably add the most value in terms of just cutting costs, increasing rents. We are focused too on, as I mentioned, high growth, population growth areas. We're looking at that new supply wave, and there's really, like I said, there's not much. So in certain areas, there's little to none at all. Even different things, Brandon, like the size of the units in markets. I mean, you can get as granular as you want. Different units and different size, 3-bedroom units, for example. Markets like, Nashville, Tennessee, that absorb studios and 1-bedrooms at record pace. They still are, but 2 and 3 bedrooms, you can't give those away in some cases. So especially with the new supply. So it's been an interesting kind of fickle, kind of environment, but that's why obviously professional management, right? That's why, real estate investors, professional managers, kind of, earn their fees, right? In markets like this. So it's some of it's a basis play, some of it's a little bit of a tailwind that we should experience once the supply drains out. But ultimately that's why you'd consider hiring professional management, right? To do something like this in this environment.
What's the biggest gap there between, we talked about the builders and they do the job of building. What's the biggest gap when you pick up one of these properties as a manager opposed to a builder? What are those operational things that you see consistently that you're making? Oh yeah, we got to make these 5 changes operationally.
So, you look at you look at ultimately, obviously the staffing and kind of what you need, what you don't need. That's something important. Marketing, right? How are these properties being marketed in that environment? And perhaps it's not the right strategy. Um, you have to look at obviously your existing tenants and what their profile is, right? And you also ultimately want to kind of match that profile. And certain markets have certain tenant bases, right? And certain commonalities naturally. Um, so, and a lot of these apartments too there's kind of live, work, play environments, right? Where these are highly amenitized, new build properties, not like, apartments we lived in growing up. I mean, they have dog runs and they have golf simulators and resort style pools and things of that nature, and common areas that, ultimately are nicer than a lot of very, very, nice homes, etc. So you're looking at that. And then of course they're also 5 minutes or 10 minutes from their, workplace, and whether it's a hybrid situation or not, they can certainly pick and choose and be flexible. So we're looking at all of that. So that's a couple of different, ways that we look at it. And I may have to come back to you with a number 5 or so.
I made that up. There might not be 5. It's
4 really good ones in the
4 really good. Those are 4 really good ones. I wanted to ask about classes, and it seems like, as you just described, highly amenitized. That sounds like Class A stuff. Are you looking below that at all, or how do you view B's and C's? Are they just not part of the equation for you guys?
Not right now, but that could change certainly very quickly. We've done it in the past where we saw opportunities to, purchase Bs and Cs, and then fix them up and ultimately, do that heavy value add and sell into that market.
Mhm.
Um, we've done it as recently as we sold a lot of B and Cs in 2022. So there was an opportunity to essentially kind of reset and call it lucky or good, but we kind of reset in 2022, which we now know is the height of the market. So we sold a lot of our pre-COVID and all that, kind of at that time, 21 and 22, we did a lot of dispositions. And then kind of, like I said, reset with new capital stacks in 22, 23. So, um, like I said, kind of good timing on our part. Also starting the firm in 2009 too was also certainly a wind at our back too. But obviously navigating, macro trends is one thing, but then kind of individual, crises and different inflection points is another. So, um, yeah, we will see some opportunities to do that. Just not right now. That's not a focus of ours.
Yeah. And it's challenge. I guess all the problems that we see in even in the Class A side of multifamily are probably enhanced in B and C, right? From if you're renovating and fixing up into a market with too much supply, good luck moving rents, right? Like that's you need that to sort of make it work. If you don't see that, it won't work. And so instead, you
Absolutely.
guys have chosen to buy assets at better levels, great assets at better levels. Like you said, the basis play seems to make a ton of sense.
Yeah. I
Um,
mean, we have even hypos. We have kind of split analysis of in our deck, et cetera. But, ultimately looking at, a property purchased in 23 and in one case, property across the street purchased in 22 and talk about basis, you reference, I mean,
yeah.
it's significant how different. I mean,
Mhm.
you can make the argument it's even a better asset that produced at, 30, $40,000 less a door. And
Wow.
that's just 1 year,
Yeah.
right? 22 to 23, right? So the height of the market versus 23, right? So things like that, that sometimes that, as a sponsor, as general partner, we're certainly going to emphasize, but it's also important to note, when you are navigating, even if you have some tailwinds and things are,
Yeah.
seem to be working, it's important that we're, navigating that internally.
As an aside, when I get on my soapbox and we get a lot of complaining about, stock market going down and a lot of crying and hand wringing about, oh, this is why I invest in real estate, blah, blah, blah. Let's look at that example that you just mentioned, right? Building across the street in 22 to 23, thousands of dollars less per door. That's a real write down that somebody has to take and hurts, right? What does that feel like? 20, 30% at this point?
You just came back.
Yeah, I lost you there. Hang on a second. Let me take a 20-second time out here.
Yeah, of course.
Figure out what's going on here. It's definitely on my end. All right, let's give this a shot. Yeah, you froze up on me pretty good. Um, how was I asking you about? See, things
Yeah,
going
no,
wrong,
no problem.
man.
So I,
And
I
edit the
left
shit out of this. It's gonna be crazy.
no, it's all right. Test your editing skills. It's always a curveball, right?
Oh man.
So I was just talking about, we were talking about B versus A properties and kind of
Yeah,
our focus. And then,
got cut off. Yeah, I was talking about a lot of the complaining about, stock market going crazy right now as we're recording this, right? Crazy volatility and a lot of crying and a lot of, oh, this is why I invest in real estate. But you said it, right? 22 to 23, those two buildings across the street from each other. What's that price difference now? 20%, 30%? It is, isn't it? Yeah. Matthew's nodding his head vigorously.
yeah, it's significant, which is, and also like,
Yeah.
I heard it on one of your other, episodes too, like the value of just not being priced daily. Obviously there's fluctuations in values, right? But
Yep.
some of these private deals and whatnot, there's a benefit to that. And then the lack of liquidity obviously is beneficial for both sides. We don't have to sell. We're not a forced seller in a 22 versus 23, to use your example. And
Mm-hmm.
then obviously the emotional side of it for the investor. So benefit of real estate naturally.
Yeah, they don't see it, but it's there. It's real. It happened. No one wants to talk about it. It feels like no one wants to tell you that values are dramatically different than where they were in 2022. No one wants to talk about that.
Absolutely.
Yeah.
A good example too, I mentioned Sun Belt markets and people moving to Florida, but we're very focused on basis. So, market is moved depending on where you are, 20 or 25%, right? These prices are 20 to 20, right? You said earlier.
Mhm.
Florida is a good example of us. For us, we just did, and we're considering more opportunities in that Florida market, which was very expensive a couple years ago. So it was almost too expensive just for our, kind of thesis. Plenty of opportunities there, and other sponsors focused there. But it's just something that we just kind of stayed away from. So we used to say we focused on, secondary and even tertiary markets. Well, now it's more primary and secondary because those secondary, markets are almost at primary prices or former primary prices. So it's just interesting dynamics, as you kind of peel back the onion and look at this stuff.
And one of the reasons you mentioned you don't have to be a forced seller. One of those reasons is probably the ability to navigate capital markets. It's debt that forces us into these situations, right? How do you guys think about, look at, navigate this current financial market from a debt perspective? Debt's hard to find, I imagine. Of course, it's a lot more expensive. How do you think your way through that?
Yeah, it's really the big, one of the main drivers behind if these deals are going to work or not, right? Certainly. So, um, we will put, we will buy, all cash equity only and then put on debt later if it makes sense. So I think the key word would be flexibility. We can entertain bridge financing in a lot of cases. I think I referenced it earlier in terms of, leasing these properties up. We need a 6 month kind of period and then with maybe a 6 month extension. And then ultimately have the ability to do permanent financing. We have some good relationships with, preferred lenders and banks and agency, financing, et cetera, that we use. So, that's something we've built on reputation over 15 years. So, we're just being very thoughtful about it, though, is really the best way to put it. So it's deal by deal and specific, and you have to get creative sometimes.
And those relationships, it's a big deal to have their hands on those and pre-established. We see much different terms for, and I'm sure you do too, for folks that have been in this game for 15 years and folks that just showed up are seeing vastly different terms about what people are able to do from a financing perspective. Kind of puts you guys in a good spot. But I thought the most interesting thing you said was buying a lot of these for cash. Do you find that's the biggest part of the capital stack at this point when you're looking to buy? It's just using the capital.
If we can do it, yeah, we would certainly consider it, and it could be a valuable thing. And you hear the terminology in real estate, time kills deals. So if you can close something and be, no, not retrade and just kind of get things in order, and get that deal done, then ultimately you're going to put yourself in a good light, versus perhaps others that aren't, so experienced in the space. It's not better or worse, just different, but it certainly makes a difference sometimes.
Now more than ever. Now more than ever. I know what I wanted to ask you about. I wanted to ask you more about UConn.
Oh yeah.
Yeah, tell us more about the relationship with your professor. You just bother the hell out of him till he paid attention. Dude, that's how I did something similar at my college to get involved in the endowment fund. I just bothered everybody until they were sick of me.
Yeah, yeah.
Fine, just come help. Just shut up. I'm so tired for you.
That's right. It sounds like we have similar personalities. You want something, the squeaky wheel, right?
Exactly.
Yeah, I mean, it was really that. It was like, kind of, what can I do to work with you and learn more about this? Kind of like, after the lecture's over and all that, and
Yeah.
kind of just being more ingrained. And I've always been pretty thoughtful about like really what I want to do, and you feel like you have some strengths and weaknesses, and just kind of leveraging those strengths. And I just understood real estate. I had some friends and family that are involved in that early on, so I always paid attention, right? Um, and then just the fact that he hadn't, I had an opportunity to kind of look at real estate deals for the endowment. And he was just, like I said, a good mentor of mine and really kind of got me involved. It's funny though, it's not a linear, um, so I said I was interested. Then I said, all right, let me do like wealth management. And so I did an internship at Smith Barney at the time that summer. And I'll never, I mean, it was a different kind of world, but I was like, let me understand kind of how wealth management and
Yep.
perhaps that kind of they can synergize the real estate with that. But I did a whole summer cold calling for this guy, and I had this list, right? It was pharmaceutical firms in New Jersey. And then Brandon had this list, and I go to him at the end of the summer and I present it to him and ends up losing the list. And he never found it, at least to my knowledge. I now, of course, looking at myself like, just learning 101 is I should have made a copy, right? Didn't, never found the list. So my whole summer was fruitless, but I didn't give up on my dream of being involved in business, wealth management, finance. So I moved from there, to spend another minute or so on it. But
No, please. It's great.
I moved to I worked for after college after UConn. I lived and worked in Hartford, Connecticut area, and so I worked for a team there, a wealth management team, wirehouse team, and just kind of cut my teeth in that. And from there, I realized that at that time, at least at that stage in my career, I didn't necessarily want to be involved in that. So I had a good relationship with the local asset manager, rep who came into the office and did lunch meetings and talked about his real estate deals and various things. And so I was like, I want to be that guy. So to the point you made about, bothering the heck out of these guys, I bothered him. I ended up working with him directly and moving myself to New York, which is at the time is growing up in New Jersey. It's where I wanted to be, at least spend some of my career.
Yeah.
Somebody once said after New York, it's all Connecticut. So I had to get there, and ultimately, experienced that city and all that has to offer. And from there, last point I'll make is, I mentioned global financial crisis. The Hamilton Point started just shortly after, and really toward the tail end of that. But I was also laid off at that time, and ended up being, the best thing that kind of happened, right? It got me from one kind of phase of my career to this, private real estate, direct investments, and kind of really traditional sponsored GP real estate world, which I'm in now. So couldn't tell me at the time. For 6 months, I was running around New York, literally going to bank branches and looking for work because I told myself I was going to stay in New York and not move home. But obviously that rent didn't change during that time. So anyway, it kind of morphed me and kind of gave me some, some battle scars and all that. But it kind of worked out, and we'll see what happens next. But it's been
If
good.
you're in your formative years in 2007, 8, and 9, you have battle scars in this space, and you have a hard hat, and you still should have it. Keep it handy. It has a chin strap attached to it too, and you may need it again. Believe you me, I think everyone has that. And we don't wish those experiences on others, but it's extremely formative probably for all of us, right? Of going through that and realizing it can get really bad, and this may feel bad, but we're kind of shrug our shoulders, right? At this point, inflection point, and go, if you're worried about this, you definitely weren't around in '08. That was end of the world stuff. So
Absolutely.
sometimes it's helpful.
Yeah, so
Great.
well said, Brandon.
Great experience. Matthew, thanks so much for joining us. Anything you'd like to leave with our listeners? Bunch of valuable nuggets here already. Anything else you want to leave with our listeners today?
No, I think we covered a lot. Like I said, appreciate the opportunity to be here and listen to your podcast and everything that you guys do, and certainly be an advocate for the real estate industry through and through. I think it's a great business, and not without its challenges, but certainly the opportunities, and that's why we're all here. So again, I appreciate it, Brandon, very much.
No, thank you so much. And you can always, listeners can always reach through us to get to Hamilton Point. We're happy to set up calls to do that. But where can people, if they want to reach out to you direct or learn a little bit more about Hamilton Point, where can we navigate or point them?
Yep, absolutely. Website, hamiltonpointinv.com. Obviously through yourself. My name is Matt Incitti, of course, and ultimately you can look me up on the website, etc., LinkedIn, and all that as well, of course.
Awesome. Matt, thank you again so much for hopping on. Really appreciate it. Multifamily is a challenging little place, and I think you guys are navigating it pretty darn well. So I really appreciate and love what you guys are doing there.
Thank you very much.
Awesome. And to our listeners, thanks for listening. We'll see you next time.